I have to read a disclaimer. Thank you, Austin, my compliance officer here at Commune Capital. Here we go. The content of this podcast is for informational purposes only, is not offered as investment advice, and should not be deemed as investment advice, and reflects the opinions and projections as of the date of this publication, which are subject to change without notice at any time subsequent to the date of issue. The podcast does not represent or warrant that the information presented is accurate, current, or complete, or that the estimates, opinions, projections, or assumptions made in this video will prove to be accurate or realized. Certain statements reflect projections or expectations of future financial or economic performance of the project. Such forward-looking statements are based on various assumptions, which assumptions may not prove to be correct. Accordingly, there can be no assurance that such assumptions and statements will accurately predict future events or the project's actual performance. Past performance is not an indication of future results. Neither this podcast nor its content should be construed as legal, tax, investment, or other advice. Individuals are urged to consult with their own tax, legal, and investment advisors before making any investment decisions. All content available on this podcast is general in nature, not directed or tailored to any particular person, and is for informational purposes only. Thank you for listening. Think you need $100,000 to start building your wealth? That is wrong. I'm going to show you how to get started with as little as $10,000, and I'm going to walk you through the strategy that I use to get me from making my first investment of $1,000 to now having a net worth into the millions. And I'm also going to show you what I would do today, considering I was getting started at 2025 as opposed to when I got started in 2003. So jumping right into it, we're going to go through 5 strategies that I think everybody should be tapping into if you're on your wealth building journey. And we're going to start this one off by what it looks like to get going with $10,000. If you only have $10,000 to invest, your best investment might not be real estate or stocks or crypto. It might be you. You have an unlimited potential return when you invest in yourself. So we're going to start on what that looks like. Before you look at markets, this is where I'm going to challenge you. What skill set do you have that you can increase, or what skill set could you learn that will give you an ability to go out there and make more money? Your income is your wealth building tool. Some of the options that you might have ranging from $500 to $2,000. Take a high income skill course. This might be a course that teaches you how to sell, how to design, how to market. You can pay for coaching or mentorship. You can attend a niche event like in real estate that shows you how to underwrite deals or maybe where to go find them. You can buy books. You can spend your time educating yourself. Now, there's some caveats here though. On some of the courses, a lot of the information that you're going to get in a course is on YouTube and it's completely free. So you don't always have to spend $10,000 to go into a high income earning mastermind. Usually you can just jump onto YouTube and get the same amount of information for free. We just tend to believe that if I spend more, that the information has to be more valuable. In this day and age, that's not true. So don't just think of an investment being with your dollars, invest your time. That was by and large where I went. The majority of my education came from books, podcasts, getting around people that were doing the business or industry that I wanted to get into, and then it was doing it. You're going to learn a lot from just getting into the weeds and figuring it out. But the reason why this is so big is doubling your income from, let's say, $50K to $100K gives you way more investable capital or investment capital than putting a $5,000 investment into a potential 10% return. So I would start by looking at yourself and finding ways to give you more tools to go out and monetize for the rest of your life. Start there. Number 2, This is your traditional plays. You're going to hear this and think it's boring, but the fastest way to go broke is ignoring the boring stuff. Don't get caught up in the trends or trying to get wealthy overnight. One of the best ways to do it is still with a retirement account and being very basic. Now, I understand I run the risk of you calling me a boomer and this not working anymore. That's not true. And we're gonna go through this. Opening a Roth IRA. A Roth IRA, I think, is still a very good option because number one, all your gains are gonna be tax-free. And number two, you can invest out of a Roth in a lot of different investments that you can't do in a traditional or a 401k. You can still invest in real estate. You have options now to get into crypto. So a lot of the things that you would do with post-tax dollars are still at play with an IRA. Here's what it can look like. Let's say you invest $500 a month in a Roth IRA. So that's $6,000 a year. Over 30 years, you're going to put in $180,000 with an average 7% return. So I'm factoring in the historical of the S&P 500 plus inflation. You're going to see about $610,000 to $650,000 in that portfolio tax-free. Now, if you took it a step further and maxed it out, which is $7,000 a year, in that 30-year window, you're going to have a total contribution of $210,000. Your ending balance, though, has the opportunity to be $770,000, all tax-free. Now, whenever I tell people this, the pushback I get is $770,000 in 30 years is nothing. That's like 50 grand today. Yes, but you're looking at it wrong. You need to look at the money that you're putting in and what you're going to get on the back end. Putting $200,000 in to make $770,000 on the back end tax-free, that's massive. That's still very important. That's the same as you basically turning your 210 into, let's call it 1.4 million, because remember, you're not paying taxes on this. Now, 401ks, for me, this is something that I think is an option if you have an employer match, because if they match you, it's a guaranteed return. But with a 401k, you are taking a different type of calculation because you will be taxed when you pull that money out. So you're making the bet that you'll pay less taxes in the future than you are today. I don't know if I can safely say that. I understand that the argument is, well, if you're not working, your taxable income is down, and so you can control your withdrawals to pay less in taxes than you would at 30 or 40 years old. But you do run the risk that taxes are going to be significantly higher in the future if you're underwriting America as we have a debt issue and we have to climb out of it, and you might want to factor in that taxes might be much higher. But it still is on the table if you consider that it's 100% guaranteed return with an employer match. Right now, crypto, this is the big one for the youth. So if you're young and you've got 10K and you're like, let's turn this into $1 million, I'm putting it all into crypto. Part of your outlook is correct. Part of it is awfully wrong. So this is how I would look at it. Crypto isn't dead. It's maturing from where it was when everybody was early in, let's call it 2010s. But how you allocate your dollars in crypto and the percentage you put into it is everything. So if it were me, and some of the kids are going to say, nah, dude, that's too conservative. How I put my money in crypto is in more of the, what I would say, coins that are closer to mass adoption. I have money in Bitcoin. I have money in Ethereum. I do have some money in XRP. I would look at that one as a potential to make a higher return, but there is more risk in my point of view. I have some HBAR, and then that's basically it. So I look at crypto as the future. I think that is absolutely where we're headed, but I look at it similar to the dot-com bubble, or maybe what's happening right now with AI. Let's use AI as the comparison. So what happens when you have a new industry that's born, or in this case, a new asset class that's born? You recognize that it's the future, and so there becomes this bubble because everybody jumps in going, AI is definitely gonna take over. crypto is definitely going to be how we buy and trade, right? But what they don't factor in is just because it's the future does not mean all the companies or all the coins that exist today are going to survive. So what happened at the dot-com bubble or bust is everybody knew that the internet was changing. So you saw all this buy-in, which created a bubble. And then all the weak companies, even some of the large ones, didn't make it through the crash, and then the strong survived. So unless you were investing in the few that worked, you pulled it. If not, you got hosed, even though it was the future. I think that's the same way we need to be looking at crypto. AI, I think, is the clearest example of a bubble that will pop. There's so much dollars flowing into the industry because everybody's bought in that, yeah, it's going to be a game changer. We will go through a reckoning, and a lot of companies will go away, and then there will be the few that become the next Googles and Facebooks and Bitcoin and what we've seen historically. So I think it still is important to do this correctly. For me, I don't even have 1% of my portfolio in crypto. I have maybe like half a point. I'm probably a little bit more conservative. If you're younger, you can definitely make the claim that I can take more risk because I have more time to get out of it. But if I was young, I would be looking at Bitcoin. I think it's exciting for the youth that you are coming into an asset class that is young because that means you have potential to grow with it. The staple investments are frustrating because home prices are high, the stock market is high, cost of living is high. I know there's an element to Gen Z that's looking around going, this is unfair. But when you look at crypto and you look at AI, I think that's the potential to kind of go into your favor as a benefit. We didn't have this when we were young. So you guys have an exciting window of, I think, riding some momentum. So still risk, yes. If you're going to buy a house, this is one of the things that if I could go back, I would do this. I grew up in the generation that told me that the best investment I could ever have was buying a home. So once I had enough money, I bought a house. And my experience was I bought in 2005, 2008 basically destroyed the market. And I had to hold my home for 15 years just to break even. So my experience wasn't what everybody told me it was going to be, buy a house and I'm going to grow my wealth that way. What I would have done looking back is I would have house hacked. I would have bought either a duplex, a quad, a duplex, triplex, or quad is what I would have bought. I would have used the FHA program. This is a first-time home buying program. So if you're young, you have $10,000 and you're just getting started, look at tapping into this program. Here's where you can turn your house expense into cash flow. The FHA loan, let's say you're going to buy a fourplex and you're going to put 3.5% down. You're going to need a credit score over 580. But if you found a duplex for, let's say, $300,000, if you live in California, you're going to say, no way, that's true. But you do have markets like Indianapolis, Cleveland. There are markets where this price point exists. 3.5% down is going to be $10,500 is going to be your down payment. You're going to live in one of the units, which you have to commit to living in for 1 year. And you're going to look at your rent for your mortgage is going to be about $2,000 a month. And you're going to have the potential of renting the other units out for, let's say, $1,200 a month. That is going to cover you for the first year. Then you're going to look at moving out of the unit, putting a tenant in, and now you're going to have a potential cash flowing asset. That is absolutely what I would have done. Some of the benefits. You have a $10,000 investment that's going to get you in the game of real estate. You can use leverage, which has the potential to increase your return. You're going to get some tax benefits. There are tax benefits that come once you own real estate as an investment, not a primary. That is going to help you play a different type of game. So that is one thing I wish I would have done as opposed to just purchasing a home. The other thing I've been thinking about a lot lately is home ownership entirely. Like, you know, I went in, I think, with the wrong lens that I was going to buy a house as an investment. Where I'm at right now, I think owning a home is a lifestyle play. I think owning a home gets you into a market that you want to live at. It does help you control your expenses. It gets you freedom to design a house however you want, but you still have to calculate that you are paying for that house every single month. There's money coming out of your pocket. The big shift that happened for me is when I started buying investment properties because I no longer had to pay to keep them alive. A tenant does that. So a tenant will pay your debt service, pay your expenses, and you typically have cash flow that then comes into your pocket every month. So once I experienced that, I stopped caring so much about owning a home. I just wanted more rental properties to increase that cash flow to a point where I could become financially free. That was the move for me. Now, if you don't want to be a landlord, because that is a full-blown thing, you can still invest in real estate through syndications. This is where you don't have to do any of the work. Tenants don't know your name. You're not a landlord, but you get to experience the benefits of owning real estate. Some of the challenges to this. For you to invest in a syndication, you typically have to be an accredited investor. So if we're talking about getting started and you only have a $10,000 investment, usually minimums on syndications are $25,000 to $50,000. So that might not be available to you if you're just getting started. If you do have the $20,000 to $50,000 investment and you're not accredited, a lot of those are going to be taken off the table as well. So there is a caveat to that. Some of the good things, though, once you are in a position to be able to do this, you get to get into bigger products than you can afford yourself. For example, I cannot go out and buy multiple $50 million apartments. I don't have the net worth to be able to do that. But when you're a part of a syndication, I can put my money in with other people and we can go out and get bigger and hopefully better projects than what I could do as an individual. So I loved that. The passive side of it, there's something maybe the better way to say it is, I liked the passive side of investing because when I was younger, I never wanted to manage real estate. I wanted to be a pro skateboarder. So I wanted all of my time to go into my career because I loved doing it. And also I viewed my career as my highest potential to earn money. So I didn't want to dilute my time into becoming a real estate manager because I then ran the risk of making less money as a pro skateboarder. And then I was actually taking steps backwards by trying to manage everything myself. So I think there is a lot of value in being a passive investor. Another pro to a syndication, you get cash flow and appreciation if you're investing in groups that are going after both. So that means if you're young, you don't have to sacrifice your appreciation play to potentially double your money just to get cash flow. You can go after both. Also, you're going to get tax advantages with syndications. If you're investing with a group that gives you a K1, you're going to get depreciation loss that will either, or maybe the better way to say it is, that can either wipe out the taxable income of the cash flow or can bring a capital gain event down. That's a very fun game that you get into. Some of the cons for investing in syndications: one, it's a longer hold period. So I would say if you're going to invest in a syndication, you need to be prepared for a 5 to 7 year hold. That means you're not getting your money out if you need it. So there's less liquidity. Some of the things, though, that I see a lot managing an investment firm that deals with passive investors is a lot of investors will go 5 years is too long. And if 5 years is too long of a hold and you're under the age of 50, just be mindful that you might be taking on greater risk in investments that are turning dollars quicker. I've always found that long-term investments is the strategy for me. Why? Because it takes out a lot of the volatility that can go into your hold period. With real estate, of course, it's always when you buy right, but a lot of the factors in real estate work themselves out over time. And if you're looking at flipping and you're looking at getting your money out in 2 years, you're not giving yourself a lot of time to work some of those, getting to your rent target, getting to your occupancy, cap rates moving on you. If you don't give yourself enough time, those become larger factors, and those factors can either reduce your return or wipe it out completely. So I've always believed that a 5 to 7 year hold actually isn't a long-term hold. That's kind of right in the middle. I typically go to a 10-year or longer horizon, but I understand that most people are not like that, especially dealing with all the investors that I speak to on a daily basis. I would say 5 ends up being the threshold. Now, I was thinking about announcing this. Yeah, I'm going to, but here's going to be my ask before I say this. I'm going to tell you guys, because you guys follow me, you watch my videos, you are part of my community. We just launched an offering where you don't have to be accredited any longer, and the minimum investment now for our offering is $5,000. So even though I just mentioned to you that syndications are an option if you're accredited and have usually a $25,000 or more principal investment, I now have an offering where that's not at play anymore. You can actually get started in real estate if you only have $5,000 or more to invest. We're doing all the real estate that we've historically done, multifamily and storage, primarily focused on multifamily. If you want to hear about what I'm doing and be a part of this new offering, I'll put the link in the description. So that could be a new option in our 5-point strategy to build your wealth. If you enjoyed this, please hit the subscribe button, hit the like, and will you leave a comment for me on if you're that profile, you're young, you're getting started, you only have $10,000, what are you doing with your money? And let me know what option you think is the best out of these 5. Love you guys. I will see you guys next week.